Hello. Thank you for tuning in to my fourth reading, titled White Man by Arthur Hayes. If you'd like more content, please check my podcast out anywhere you listen to podcasts. It's titled Web3 TV. Let's begin. White Man. Any views expressed in the below are the personal views of the author and should not form the basis for making investment decisions, nor be construed as a recommendation or advice to engage in investment transactions. Reflections. Last week, I described how Sam Bankman was the right kind of white boy, and how he leaned into his persona to convince the Western financial establishment and the crypto industry alike to overlook his shortcomings and not ask too many questions. Here is how he describes what he did in his own words to Vox. Yeah, I had to be. It is what reputations are made of, to some extent. I feel bad for those guys who get effed by it, by this game we woke Westerners play, where we all say the right shibboleths, and so everyone likes us. Of the fallout that we began to see this week from SBF's apparent epic fraud, perhaps the most significant casualty is the likely insolvency and potential bankruptcy of crypto lender Genesis, which could be mega enough to also bring down its parent company, prominent venture capital firm Digital Currency Group, or DCG. The Genesis DCG melodrama, which also includes Genesis' sister firm, digital asset Grayscale, is particularly impactful because it directly affects the largest Bitcoin investment product listed on any exchange, Gbtc. The reason why Gbtc is so important to us crypto traders is that it holds one of the largest stashes of Bitcoin. Should investors, willingly or not, be allowed to redeem Gbtc shares for Bitcoin or USD, it could spark the next brutal leg down in the fiat price of Bitcoin and other shitcoins. Now that the peerless image of SBF has been shattered, investors have recovered their ability to do maths and read public statements. They have begun to ask questions of everyone and afford no one the benefit of the doubt because of some aspect of social conditioning that allowed their rational brain to silence their gut instinct or lizard brain. The entire point of these readings is to alter your thinking for the future. When the next person comes along who says the right things or the quote-unquote right clothes on, went to the quote-unquote right schools, and speaks and looks the quote-unquote right way, hangs out with the quote-unquote right people, is promoted by the quote-unquote right media outlets, I hope that you disregard all of that and focus on the truth that is self-evident in the mass and public statements presented. In this essay, I'll be delving into the digital money management business and breaking down the Genesis DCG Grayscale soap opera GGGGG unit. And as the essay comes to a close, I'll lay out a rubric for evaluating a potential means of profiting off this carnage. But first, similar to how I began part 1 of this series, let's revisit Pax America and do a little bit more racial theorizing. Barry Silbert, the man atop this shaky DCG Genesis Gbtc empire, is just a foil for a broader point I'm trying to make throughout this series on how stereotypes hinder investors' ability to properly manage risk. All of the information that is presented in this essay has been public for many years, but no one bothered to ask questions because Billy Silbert fit the mold as the type of guy that you would trust in the Pax American business world, i.e. a confident white guy saying all the right things. To be clear, I'm not saying that this whiteness was in some way a driver of the actual events taking place with Genesis. All I'm saying is that because he's white, he appeared trustworthy. and as a result, investors followed him blindly without digging deeper into how all of the pieces of this empire fit together.
This is not at all an indictment of being white. It's an indictment of the system and its willingness to overlook someone's shortcomings because they look a certain way and say the right stuff. I don't know the man. We aren't even acquaintances. And I have no financial exposure to his kingdom. With that, let's jump in and start by looking at how this broken system works and how some folks engender the trust of their peers without raising further questions. Peep Village needs a money manager. Unless you want to store wealth in physical cash or gold and conduct all transactions face-to-face, it is impossible to self-custody your assets in the analog TradFi system. You simply have to entrust your assets to banks and money managers. These intermediaries allow money and assets to move from point A to point B. As we know, there is a significant amount of trust involved here. You trust the bank is not making bad loans that will impair its ability to pay back your deposit. You trust the person or organization that manages your money won't just steal it or send it to dodgy investments. In light of the need to trust your financial intermediaries, how do you choose which person or organization should manage your money? Let's conduct a silly little exercise. Imagine there is a village called Pepe Village. The inhabitants of Pepe Village are green frogman creatures. Pepe Village is quite isolated. They don't get many human visitors, but they are connected to our civilization through trading memes with us. Selling these memes to humans nets the Peps a lot of money, which they want to use to invest for the future. The village, while not visited very often by humans, watches a lot of TV. The shows on air come from Pax Americana, so Pepe Village is very up to date with Pax American culture. One day, 8 salespeople visit Pepe Village. Each person's goal is to convince Pepe Village to allow them to manage the village's wealth. There are 2 salespeople, a man and a woman, that Pax American calls white. There are 2 salespeople, a man and a woman, that Pax America calls black. There are 2 salespeople, a man and a woman, that Pax America calls Asian. And there are 2 salespeople, a man and a woman, that Pax America calls Hispanic. These monikers would be strange to the villagers if it weren't for the large amount of TV they watch. The villagers have watched enough TV to know what these terms means in Pax America. The Pepe Village Council of Elders met to receive each salesperson and hear their pitch. Each pitch was exactly the same. Hello, my name is blah 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 blah. I work for blah 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 blah. You should trust me because I studied finance at blah 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 blah. And finally, most importantly, I charge a 2% management fee and my track record is blah 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 blah. After the 8th person presented, the chair of Pepe called the meeting to order so the council could decide which person to entrust with the village's savings. Wow, I'm confused, said the chair Pepe. Apart from the different genders, each salesperson had the same name, went to the same university, studied the same thing, wore the same clothes, and underperformed the market by the same amount. They even all charge the same price. Wait a minute. These people come from different races. One of the other council members, Wojak, chimed in. That's what they call it on TV. The TV presents each race differently. So if we just follow what the TV tells us, surely we will be able to pick the most trustworthy person. That's a great call, Wojak, Chair Pepe responded. I know you watch the most TV of anyone in the village. Can you tell us which race the TV says is most trustworthy? I do indeed watch a lot of TV, says Wojak. Typically, this is what I have learned. The male Hispanics seem to always be doing manual labor like construction or landscaping. The female ones are housekeepers or nannies. Their bosses, usually the white ones, None of these, to me, says that the Hispanics know anything about managing money. The Asians seem to be good at math and science. I also see them playing roles where they are good students in these subjects. I also see them operating lots of small businesses in parts of the city the big white-owned businesses won't touch, like the black inner-city ghettos. While the TV says they are smart and hardworking, I don't really see them ever managing the money of others to large extent. They are also presented as meek and socially awkward sometimes.
The blacks always seem to be poor. They are always fighting in their dilapidated parts of town. There is a lot of violence whenever I see these shows featuring them, but sometimes I see them dribbling or throwing and catching balls, and the whites seem to enjoy watching them do athletic pursuits, but I never really see them managing money or running large important companies. The white ones seem to always be in charge. It doesn't really matter their circumstance. The white characters are always in a position of power, and it appears everyone looks up to them. I think they must know how to manage money the best and are the most trustworthy. Chair Pepe looked quite pleased with Wojak's analysis. Well, there you have it. We should pick either the male or female white salesperson. Wojak, what does the TV tell you about whether men or women are most trustworthy? We should definitely trust men more than women when it comes to finance, Wojak responded. I watch these financial entertainment channels, and they always have attractive women interviewing powerful men who seem to run all the financial businesses. Chair Pepe nodded and added, does anyone in the council oppose choosing the white male salesperson to manage our assets? No one challenged their Chair Pepe. The ABCs of asset management. With that little thought experiment out of the way, let me hop off my soapbox and jump into the meat of how this DCG, Genesis, and Gbtc, the G unit situation came to pass. Because it's impossible to self-custody your wealth in the TradFi system. You must entrust it to an asset manager. This means that everyone in the industry can be terrible at their jobs and still make money. And because it's easier to be bad at your job than good at it, asset managers have to erect moats around their businesses to protect their ability to continue being mediocre. It is very hard and expensive to open an asset management business. There are lots of rules you must follow, and to ensure you are in accordance with these rules, you must employ a wide range of specialists who each focus on one specific area, which gets very expensive. The only way to win the game is to manage a large pool of assets. This is because, for someone looking to hire an asset manager, the biggest difference factor tends to be management fees, and fund managers with larger assets under management have much more flexibility when it comes to setting their fees. As a quick aside, you would think track records and past performance would be the biggest differentiating factor, but the reality is that it is so difficult to outperform the market over an extended period of time that asset managers' track records tend to be very similar and tough to distinguish between the average. The costs to run the business do not vastly increase as your assets under management grow. Operating a fund with $1 trillion of assets under management is not significantly more expensive than operating one with $1 million of assets. This means the larger the assets under management, the more a manager can lower prices and still have high profit margins. The outcome of that is a natural oligopoly in the market. Because the costs are relatively fixed regardless of assets, large funds can easily put smaller managers out of business by lowering their fees below that which smaller managers can afford to charge. Therefore, for new entrants to successfully break into the asset management game, they need to offer a product their competitors won't touch. Remember, just a few short years ago, crypto was untouchable by firms like BlackRock and Fidelity, even with the significant demand for a Bitcoin tracker product. At the time, there were many people who wanted to enjoy the financial return of Bitcoin but did not wish to actually use the technology. Setting up a wallet safely, storing their private key, and finding a trustworthy exchange on which to purchase Bitcoin was too much of a hassle. Just like most other commodities or currencies, these investors wanted an exchange-traded product they could simply purchase with fiat in their brokerage account. And for this privilege, they were willing to pay exorbitantly high management fees. Whom shall the prospective Bitcoin investors trust to manage their exposure? Well, there exists such a white man. His name is Barry Silbert. I like to refer him affectionately as Mr. Shilbert, because as shameless promoter of himself and his financial products, he knows the ABCs. Always be closing. In Bitcoin we trust. Despite many efforts by many different groups to secure approval for one from the SEC, it eventually became clear that an exchange-traded fund, or ETF, whereby a manager accepts cash or Bitcoin from an investor and uses it to create units of an ETF, which then trade on the stock exchange in the capital of Pax America, New York City, was not in the cards for U.S. investors. Recognizing the lack of an ETF had created significant pent-up demand from less tech-savvy investors looking to get in on the Bitcoin action, Mr. Shilbert found a way to create the next best thing. He developed a trust, the Grayscale Bitcoin Trust, or Gbtc, which investors could create shares by offering tendering USD or Bitcoin. After 6 to 12 months, an investor could convert their shares in the trust to a security that got traded on the pink sheets. Oh, and I forgot to mention, this product was a bit like Hotel California. Once you checked in, you couldn't check out. It was, and remains, impossible to redeem your Gbtc shares. Once you are invested, the only way is to sell Gbtc at whatever price it fetches in the market. If there are no buyers, you suck. While it wasn't on the New York Stock Exchange's main board, anyone with a brokerage account capable of trading U.S. stocks could buy Gbtc. With its creation, lots of investors who wanted to reap the benefit of Lord Satoshi's vision without actually buying into his teachings could now get into the action. Perhaps the most important thing to remember about Gbtc is that it carries an extremely high management fee of 2%. To put that into context, the Spider, one of the most traded financial instruments in the world, charges 0.0945%. Mr. Shilbert is able to charge so much because it's a complicated, expensive, and time-consuming process to set up a trust of this type. No Bitcoin ETF product has been approved, and no traditional asset managers wanted to touch Bitcoin in the beginning, meaning that no bigger firms have been able to push him out of the market by offering lower fees. In short, people have been willing to pay the fee because there hasn't been any competition, and they were desperate for exposure when the price of Bitcoin was appreciating. As a result, Gbtc is a money printing machine and the crown jewel of Mr. Shilbert's crypto empire. The fees that Grayscale throws off fund everything else Mr. Shilbert does in the industry. Mr. Shilbert constructed whole businesses around growing the assets under management of Gbtc. Once the money entered, it couldn't leave, and it was ripe to pay management fees to Mr. Shilbert.
Circles. I want to thank Data Innovation for this article, which lays out the little games that Mr. Shilbert was likely playing with DCG, Grayscale, and Genesis. According to them, here is how Mr. Shilbert's little game of smoke and mirrors worked. The goal: grow the assets under management of Gbtc and clip the 2% management fees on the trapped capital. Let's walk through a chart that illustrates this. Step 1. Get capital into Genesis. Genesis and Gemini entered into a partnership whereby Gemini would lend its customers' capital to Genesis for a fee. This was called the Gemini Earn product. As a Gemini user, you could pledge your BTC or USD and receive interest from Gemini. Gemini took these funds and lent them to Genesis at a rate higher than it paid to users through Earn. Now Genesis had lots of capital to lend. Remember, Genesis is the business of crypto lending. I don't know if this was the only way Genesis funded its loan book. The job of a lender is to borrow cheaply based on the perceived strength of its balance sheet, risk acumen, and lend at a higher rate. I have to assume that Genesis was able to borrow from other firms at attractive rates based on the perception that up until recently it was the best managed and largest centralized crypto lending firm. Step 2. Create Gbtc with borrowed money. Genesis would lend Bitcoin to firms like the now defunct Three Arrows Capital and BlockFi, and those firms would turn around and give their borrowed Bitcoin to Grayscale to create Gbtc shares. We know that Three Arrows Capital was the largest firm doing this trade, as they held so many shares they had to declare them to the SEC. Screenshot of a historically quarterly record of the largest holders of GBTCs showed Three Arrows Capital at number 1. Three Arrows Capital and others participated in this trade because the GBTC shares they created traded at a premium on the open market. GBTC traded at a premium because it took 6 months to create shares, which meant that even as demand for GBTC increased during the recent bull market, the only shares available to buy were those created 6 months prior. This led to a situation in where there was more demand to buy GBTC than there were willing sellers. As a result, buyers were prepared to pay more than what the underlying Bitcoin assets were worth in order to get their hands on what little GBTC was available and gain exposure, without having to go through the process of buying Bitcoin itself. Basically, the process looked like this. Three Arrows Capital borrows Bitcoin from Genesis. Three Arrows Capital hands the Bitcoin to Grayscale and creates GBTC shares for itself. In 6 months, Three Arrows Capital receives the GBTC shares and hopefully sells them at a premium on the market. Remember that Genesis is borrowing USD from Gemini.
Step 3. Lend USD against GBTC for collateral. Remember that Genesis is borrowing USD from Gemini and its Gemini Earn product. It is paying a fee for this USD, so it needs to find someone to lend the USD so it can turn a profit. Genesis turned around to firms like Three Arrows Capital and said, "Hey, thanks for creating all those GBTC shares with my sister company Grayscale. Since they won't turn a profit for you until you can sell them 6 months from now, how about you hand them over to us as collateral in exchange for a USD loan?" Three Arrows Capital agreed and was happy to get immediate USD liquidity on the profit it wasn't expecting for another 6 months. We know that Three Arrows Capital borrowed up to $2 billion using the circular method, generating a lot of fees for Genesis. Mr. Schilbert doesn't fuck for free. And that $2 billion is how Zhu Su and Kyle Davies, the principals behind Three Arrows Capital, got to live out their big pimpin' fantasy. Unfortunately for them, like most streams, they woke up and went bankrupt before taking delivery of their yacht. Step 4. Market. Please don't go down. Unfortunately, this whole circular jerkfest was predicted on GBTC continuing to trade at a premium. As the premium turned into a discount in 2021, firms like Three Arrows Capital and BlockFi couldn't afford to pay for the USD loans they had taken out from Genesis, because they had given the GBTC to Genesis as collateral for their USD loans. When the value of GBTC dropped, they were in danger of needing to put up additional collateral to cover the GBTC's losses in value. To put this in layman's terms, when you take out a loan of this type, you give the lender some amount of assets in return. If you can't repay the loan, they can at least repossess the assets you pledged, also known as collateral, and recoup some of their losses. If the asset you pledge falls in value, you need to provide more of it in order to maintain the agreed upon collateral. Why? Well, if lenders simply allowed the value of a borrower's collateral to continue falling without requiring them to put up more, it could hit zero, and it would negate the whole point of holding collateral in the first place, which is to have insurance against losing the entirety of the money you lent out. Being required to put up more capital in this fashion is also known as being margin called. If a borrowing entity facing a margin call fails to put up more capital, it defaults on its loan. Since the value of other assets they owned was simultaneously blowing up, see Terra Luna, Three Arrows Capital, BlockFi, etc., were in the danger of not having the funds necessary to pay up for a margin call. In steps, DCG, the owner of Grayscale and Genesis, who didn't want the 3ACs and the BlockFis of the world to be margin called, because then they wouldn't be able to recoup the funds they had lent to those companies. To avoid this, DCG attempted to stop the price of GBTC from falling by raising equity and using cash in its balance sheet to apply buying pressure and purchase GBTC at the open market. Unsurprisingly, this failed. As you can see in the above screenshot, the GBTC Holdings DCG is now the largest holder of GBTC. The Data of Innovation post lays out a timeline on how DCG stepped in as the buyer's last resort. One question that always bugged me is how DCG financed its purchases of GBTC. Mr. Shilbert is a seasoned financier, and in finance, you always use other people's money. Now we know that DCG borrowed money from Genesis. While it's not confirmed what DCG used said funds for, it is possible that DCG borrowed from Genesis so that it could purchase GBTC. It would explain why DCG needed to borrow funds from Genesis while Grayscale was throwing off hundreds of millions of dollars worth of management fees. DCG was able to borrow cheaply on the back of Genesis. DCG was able to borrow cheaply on the back of Genesis's sterling reputation as the best crypto lending shop. As an investment firm, if DCG had gone out to the market on its own to raise this capital, it would have been asked a lot more questions about why it needed to borrow the money and ultimately pay a higher rate in much smaller size. Bad debt. In a bid to corral as much capital as possible into GBTC, Mr. Shilbert and his collaborators effectively destroyed Genesis and DCG. That is because Three Arrows Capital, BlockFi, and many others who put this trade all defaulted on their loans. They defaulted because, number one, GBTC went from a premium to a discount. GBTC was the collateral underpinning all of these loans, and when GBTC lost value, the loans became bad. Number two, the Terra Luna collapse affected many of Genesis's borrowers, such that any other collateral provided their Bitcoin and USD loans was also in the dumpster. Remember that Bitcoin, Ether, and the whole shitcoin complex declined 50% to 90% in the weeks after the Terra ecosystem collapsed. And a coup de grace was the stupendous con job executed to perfection by do-gooder white boy Sam Bankman-Fried. Alameda also borrowed from Genesis, and I can't imagine they didn't have the GBTC premium trade on as well. Pause. These are all Genesis issues, not GCG or Grayscale issues. How did this credit contagion metastasize into stage 4 credit cancer and become life-threatening to the entire G unit? Mr. Shilbert provides some clues in a recent update. He writes, "Dear shareholders, there has been a lot of noise over the past week, and I want to get in touch directly where we stand at DCG. Most of you are aware of the situation at Genesis, but to recap up front, Genesis Global Capital, Genesis's lending business, temporarily suspended redemptions in new loan originations last Wednesday, November 16th, after market turmoil sparked unprecedented withdrawal requests. This is an issue of liquidity and duration mismatch in the Genesis loan book. Importantly, these issues have no impact on Genesis's spot and derivatives trading or custody businesses, which continue to operate as usual. Genesis leadership and their board decided to hire financial and legal advisors, and the firm is exploring all possible options amidst the fallout from the implosion of FTX. In recent days, there has been chatter about intercompany loans between Genesis Global Capital and DCG. For those unaware, in the ordinary course of business, DCG has borrowed money from Genesis Global Capital in the same vein as hundreds of crypto investment firms. These loans were always structured on an arm's length basis and priced at prevailing market interest rates. DCG currently has a liability to Genesis Global Capital of $575 million, which is due in May of 2023. These loans were used to fund investment opportunities and to repurchase DCG stock from non-employee shareholders in secondary transactions previously highlighted in quarterly shareholder updates. And to this day, I've never sold a share of my DCG stock. You may also recall there is a $1.1 billion promissory note that is due in January 2032. As we shared in our previous shareholder letter in August of 2022, DCG stepped in and assumed certain liabilities from Genesis related to the Three Arrows Capital default. As stated in August, because these are now DCG liabilities, DCG is participating in the Three Arrows Capital liquidation proceedings on the creditors committee and is pursuing all available remedies to recover assets for the benefit of its creditors aside from the Genesis Global Capital intercompany loans due by May 2023. In the long-term promissory note, DCG's only debt is a $350 million credit facility from a small group of lenders by Eldbridge. Taking a step back, let me be crystal clear. DCG will continue to be a leading builder of the industry, and we are committed to our long-term mission of accelerating the development of a better financial system. We have weathered previous crypto winters, and while this one may feel more severe, collectively, we know we will come out of it stronger. DCG has only raised $25 million in primary capital, and we are pacing to do $800 million in revenue this year. I bought my first Bitcoin a decade ago in 2012 and made the decision that I would commit to this industry for the long term. In 2013, we founded the first Bitcoin trading firm, Genesis, and the first Bitcoin fund, which evolved into Grayscale, now the world's largest digital cryptocurrency asset manager. Foundry runs the largest Bitcoin mining pool in the world and is building tomorrow's decentralized infrastructure. CoinDesk is the industry's premier media, data, and events company, and they have done phenomenal work covering this crypto winter. Luno is one of the most popular crypto wallets in the world and is an industry leader in the emerging market. TradeBlock is building a seamless institutional trading platform, and as the newest subsidiary, HQ is establishing a life and wealth management platform for digital asset entrepreneurs. Each of these subsidiaries are standalone businesses that are independently managed and operating as usual. Lastly, with a portfolio of 200 plus companies and funds, we're often the first check for the industry's best founders. We appreciate the words of encouragement and support along with others to invest in DCG. We will want you to know if we decide to do a financing round. Despite the difficult industry conditions, I am as excited as ever about the potential for cryptocurrencies and blockchain technology over the coming decades, as DCG is determined to remain at the forefront. Barry. Remember, folks, Mr. Schilbert is an excellent financier and accountant. Here is my guess as to what is going on with these intercompany loans. In a credit crunch, bad loans are only recognized as such once the lenders stop lending. Loans to Three Arrows Capital on Genesis's balance sheet were always poorly underwritten. However, even after the Three Arrows Capital bankruptcy, there is still a chance for recovery, but no one knows what the recovery percentage will be, and therefore, the recovery percentage is whatever someone is willing to trade at. For example, if DCG is willing to purchase Three Arrows Capital loans at par, and DCG assumes over a 10-year time horizon that Three Arrows Capital will be able to pay them back in full due to a rise in crypto prices, then Genesis gets to sell a Three Arrows Capital debt asset to DCG at 100 cents on the dollar rather than, say, 0 or 10 or 20 cents on the dollar. Mr. Schilbert told us that DTG assumed Three Arrows Capital loans from Genesis loan book, so the only question is, what did DCG pay for them? In a purely accounting sense, if DCG pays par, then Genesis is insolvent. That's good, right? However, how did DCG pay for the asset? Mr. Schilbert told us that DCG assumed Three Arrows Capital loans from Genesis's loan book, so the only question is, what did DCG pay for them? In a purely accounting sense, if DCG pays par, then Genesis is solvent. That's good, right? However, did DCG pay for the asset? Mr. Schilbert told us that Genesis lent DCG the money, which to purchase assets on Genesis' balance sheet at, I believe, the most favorable valuation for Genesis, which is par. This is a bit of a left-hand, right-hand fugazi transaction. The bad debt just got shuffled from one member of the G unit to the other. But if you're trying to preserve the appearance that Genesis is a solid lender, then executing this accountant sleight of hand achieves the goal. Well, surely, Genesis would charge a member of its G-Unit family a market rate of interest. Again, we actually don't know, because Mr. Schilbert didn't tell us the exact rate or anything beyond that it was an arm's length transaction. But Mr. Schilbert has T-Rex arms, so I wouldn't be too comforted by this statement. Contrary to what we believed several months ago, DCG did not put any new hard cash into Genesis. The radioactive Three Arrows Capital loans were just moved out of sight and put out of mind until FTX Alameda blew up. Genesis had exposure there as well. Other DCG debts include $575 million borrowed from Genesis to do investments and buy back DCG stock, and $375 million credit facility. DCG is loading up on a lot of debt, around $2 billion in total. Now this isn't much of an issue when your crown jewel Gbtc is throwing off $400 million per annum in management fees, as it was on track to do before the summer crypto crisis when Bitcoin was at $30,000. But now that the run rate is $200 million at Bitcoin $16,000, the DCG Jenga game is a bit more wobbly. Now Lil Wayne told us what to do in these situations.
Records taking over for the 99 in the 2000.
They go wobblety 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 wobblety. Drop it like it's hot. Obviously, the further drop in Bitcoin, Ether, and shitcoin collateral, coupled with what is probably a Jupiter-sized hole in Genesis' balance sheet following the FTX Alameda blowup, was too much for Mr. Schilbert to financially engineer his way out of. If it were any other way, surely Mr. Schilbert would pay the same trick with DCG by buying Genesis bad debt by borrowing money from Genesis. I'm guessing here, but I suspect that whoever was supplying the capital for Genesis to lend out probably shut off the taps, and without access to outside dry powder, the film credits started rolling on the G Unit. Finally, cold hard maths and excessive leverage forced socially conditioned Muppets to snap out of it and became disconcerting investors once more. There are so many questions about what is actually going on inside the G Unit. But I know one thing. Reading what I have read about the situation and using my noggin, DCG and Genesis are untouchables, and obviously my sentiments are shared, otherwise Genesis wouldn't be teetering on the verge of bankruptcy. The result of all this is that DCG has some tough choices to make. Will Mr. Schilbert allow new money to take a cut of his Gbtc management fee stream of income? Will Mr. Schilbert dump more Gbtc onto the market to raise cash to plug capital holes in the G Unit? Mr. Schilbert outrightly used other people's money up until now. Will he dip into his own deep pockets to save his empire? All roads lead to Gbtc and the Grayscale Trust. Grayscale is the only good asset that throws off serious cash within the G Unit. Will the Gbtc discount widen as DCG is forced to possibly sell it? Will something happen to Grayscale that would either dissolve the trust, which would allow holders of Gbtc to capitalize on the 40% discount? Now that we understand the mechanizations of this particular white man, we can make some money. The next section of this essay will be a technical discussion on how to trade this dislocation in the market. The trade. Gbtc is at a discount. There are two trades here that we must evaluate. Trade 1. Bitcoin USD price neutral. 1. Sell USD, buy Gbtc. Open a short Bitcoin USD perpetual swap or short Bitcoin USD futures position to hedge the Bitcoin USD exposure. Wait until either the discount swings into a premium or Gbtc can be redeemed at par. If Gbtc swings into a premium, sell short Gbtc, buy USD, then close the derivatives position. If Gbtc can be tendered for either Bitcoin or USD, redeem Gbtc. If you receive BTC, sell it for USD, then close the short derivatives position. Trade 2. Long Bitcoin. Sell USD, buy Gbtc. Wait until either the discount swings into a premium or Gbtc can be redeemed at par. If Gbtc swings into a premium, sell Gbtc, buy USD. If Gbtc can be tendered for either Bitcoin or USD, redeem Gbtc and you'll receive Bitcoin. Sell it for US dollars. Financing hedging costs. All rates per annum. The USD opportunity cost is 5%. The Gbtc management fee is 2%. The derivatives cost is 0.5%. The time horizon is 2 years. The total financing cost is 15%. The derivatives cost is the annualized discount taken November 23rd of 2022 of the BitMEX 30 June 2023 Bitcoin USD futures contract. Whenever we evaluate arbitrage trades, we must consider the financing and opportunity cost of capital. Gbtc will be fully funded. Your broker will not give you leverage. Therefore, you need to either borrow USD or use USD capital that you own outright. In either case, there is a cost. Let's assume that you would use USD you own free and clear to purchase Gbtc. Given that I can purchase a 2-year U.S. Treasury note at approximately 5% per annum, that is my cost or opportunity cost of capital. Next, we have to consider how much it would cost to hedge our Bitcoin USD risk. If we conduct this trade price or delta neutral, right now the perpetual swaps and futures contracts are trading in backwardation. That means that the futures price is lower than the spot price. Therefore, as a short contract holder, we pay for the privilege of profiting if the Bitcoin USD price declines. Unfortunately, there is not much liquidity in futures contracts with maturities longer than 6 months. That means that derivatives funding costs cannot be knowledgeable a priori. If it takes a long time for the GBTC discount to swing to a premium or for GBTC to be redeemed at par, then we are subject to the price of rolling our futures contracts. If we are conservative and assumed it will take 2 years to realize an acceptable exit from this trade, then the table above lists the cost of this trade. The income is the 40% discount as of the 23rd November of 2022, or whatever your executed level is of GBTC in the market. At current levels, this trade has 25% of juice in it, 40% of income buying at a discount, and eventually selling at par versus 15% cost of financing and hedging position. The premium or discount of GBTC is positively correlated with the rate of change of price of Bitcoin. If the Bitcoin price is accelerating quickly to the upside, GBTC will trade at a premium. If the Bitcoin price is accelerating quickly to the downside, the GBTC will trade at a discount. It is important to understand the normal price of Bitcoin is not relevant. GBTC at 16K Bitcoin is at a discount today because Bitcoin came off high of 69K. GBTC at 10K back in 2020, when Bitcoin was coming off a low of 3K, was at a premium. This is a path-dependent variable. Therefore, if you believe that a bottom has been reached in the price of Bitcoin, all that it would take is for the direction of the price to change and GBTC could swing into a premium. Therefore, for those who believe that we are at the bottom, this is a great way to juice up a long bias trade. That is because you get the extra kicker of the GBTC discount. Financing costs are still applicable. Let's say you believe the sentiment will change in the next 6 months, with Bitcoin rallying quickly from 16 to 30K and GBTC swinging from a 40% discount to a slight premium. The fact is that Bitcoin doubled is not extra income. That is because you could have just purchased physical Bitcoins outright without engaging in this strategy. Therefore, the incremental extra income here for a directional long bent of Bitcoin is 36%. Crypto Haze, are you doing any of these trades? My answer, not at this time. There is another unquantifiable opportunity cost of capital risk that is evident in either scenario. Looking up scarce USD capital into a trade with an underdetermined time frame, I do not know when Bitcoin's price action will reverse, nor when, if ever, I will be able to redeem my Bitcoin, if I will be able to redeem my GBTC shares at par. I am happy to sit in U.S. Treasuries with my spare fiat. That is because the Treasury market is the most liquid in the world. Should there be a serious distressed crypto asset that is puked out of one of these bankruptcies, I want to stand ready with dry powder. The GBTC trade will be liquid right now, as volatility in its price and discount increases on the way down. As crypto winter sets in and volatility plummets alongside trading volumes, all types of crypto assets and derivatives will become illiquid and GBTC will be at an outlier. In short, it is a big door in, small door out. And as an experienced trader in emerging market equities, I know to steer clear of these trading setups. As always, there is just my opinion, not financial advice. Please do your own research. How to redeem. The inability to exit the GBTC Roach Motel is a good and bad thing for crypto capital markets. It's a good thing because there is an easy way to redeem GBTC at these heavily discounted levels. It would mean a huge amount of physical Bitcoin selling would occur. Holders of GBTC would either redeem their shares to capture the premium and then dump Bitcoin they receive, or the trust would dump the Bitcoin on their behalf and give the investors USD in exchange for their USD. Either way, bad news for bears. Because it is basically impossible to redeem GBTC, this capital is ripe pickings for Mr. Schilbert's management fee collecting machine. I took a detailed look at the GBTC prospects to stress test this assumption. Here is what I found about the avenues through which GBTC can be redeemed. Redemption path. 75% or more of the shareholders vote to dissolve the trust. This is a very high hurdle to force a closure. Therefore, I consider it highly unlikely that a desperate number of shareholders could be convinced to vote to redeem the trust. Given that not all of the shares are publicly traded in the trust, even if you wanted to buy up all the GBTC publicly available shares and vote for dissolution, you still wouldn't be able to accrue enough to meet the 75% threshold. If DCG was not on board, given they hold approximately 10% of these shares outstanding, then you would need at least 83% of remaining shareholders to vote yes. This makes it even tougher to prevail. Redemption Path 2. The sponsor elects to dissolve the trust. As of the November 23rd, 2022, the trust had assets valued at approximately $10.2 billion. That means Grayscale, by extension, Mr. Schilbert, had clipped $204 million each year in management fees. The amount of work it requires to receive said monies is close to zero. Therefore, why in the frick would you voluntarily decide to dissolve the trust? Obviously you wouldn't. Redemption Path 3. SEC grants a Regulation M exemption. This exemption basically allows holders of GBTC to redeem at the net asset value of the fund. Grayscale is currently suing the SEC to get this exemption for the trust. The argument is simply that because the SEC won't allow GBTC to convert into an ETF, that the SEC should grant an exemption. I cannot handicap the likelihood that this lawsuit will prevail, but in any case, we won't get more clarity on the thinking of the court until Q1 2023. So it's impossible to know the likelihood of success of this avenue, and, if successfully, how long is it going to take? But let's assume there is a 50% chance of success within the next 1 year. That is a chance you pay full financing and management fees for a year and are unable to redeem. And on the flip side, there is a 50% chance you pay full financing and management fees for a year and are still unable to redeem. All of that work and risk for 12.5%. This is far from the slam dunk trade, but it might be worth a nibble. That said, I still wouldn't do this trade, as my scarce fiat capital would be locked up for a year and unable to participate in other unknown distressed crypto opportunities. Maturity. Our cucumber munching do-gooder little white boy is just a boy because his con was too flagrant. As a parasite, you don't want to kill the host. It is better if the host lives and you let them bleed slowly. The white man was a boy once, but he learned the value of patience. The GBTC management fee scheme is a much better operation than blatantly stealing $10 billion of your customers' money. It is a much better way to earn your daily bread from willing participants. Mr. Schilbert never forced anyone to invest in GBTC. Every owner of this product did so willingly, and while there might hoot and holler about why it's against the best interest of the investors of GBTC to retard the redemption process, when it comes down to it, everyone who owns this product knew they couldn't get out when they purchased it. Furthermore, if they want to get out, they have a public market they can turn to where there are buyers, albeit at a very low price, willing to buy GBTC should they wish to sell. If you find this tale a bit sketchy, weird, and funny, then boycott the TradFi parasitic financial markets that allow this behavior. If you want crypto, go to your favorite exchange and purchase Bitcoin or other cryptos and immediately withdraw them to your own hardware wallet like a ledger. Stop buying Fugazi financial products like GBTC. Don't continue to enable smooth operators like Mr. Schilbert. Lord Satoshi gave everyone the tools to become their own financial institution. If you refuse to bask in the light of the Lord, be not upset when you must dine with the devil. That will be all for today's reading. Thank you.